I understand that Tom Waters is next from the Community Service Society.
Yes, thank you.
Good morning.
Morning.
Welcome.
So thank you for this opportunity to present on the Community Service Society's concerns about the potential impact of rent guidelines on low-income New Yorkers. We're very proud to testify at this hearing almost every year, and I'm not going to read everything that I have prepared, but I will summarize it. I'm going to talk about what the status of low-income renter households in New York City is using the most recent data. I'm going to respond to a question that a couple people asked me about the high guidelines that were issued in 2009, 10, and 11 and their lasting effect. And I'm going to talk a little bit about sort of my view, CSS's view, about what the long-term strategy of the board should be in setting guidelines in a way that would be responsive to tenants' needs. So first, on the latest data, the best data on the condition of rent-stabilized tenants comes from the New York City Housing and Vacancy Survey, which is done every 3 years. We had fresh data from that last year, but this year we don't. So instead, I'm presenting an analysis that's primarily from the American Community Survey, a perpetually ongoing survey of the U.S. Census Bureau. Looking at rents and incomes, rents have outstripped income consistently over the period that I'm looking at, which is since 2007. And that's seen in Figure 1. It's not that surprising. You all already know that. I also include an indicator of what the rent would be for a household that took a one-year lease every year subject to your guidelines and didn't have any other increases. And you can see that it rises less rapidly than actual rents, but more rapidly than income. I should note that the trouble with the American Community Survey is it doesn't distinguish different kinds of tenants. So this is looking at unregulated tenants, public housing tenants, Mitchell-Lama tenants, in-rem, everybody. So your actions don't explain everything that we see in there, although I think that the rent-stabilized rents also rise faster than your guidelines because there are other ways to raise rent on rent-stabilized apartments, especially during vacancy. And unfortunately, there's nothing you can do about that. I should also mention this is not inflation adjusted. I wanted to be able to compare your guidelines to the actual numbers, so therefore there's no inflation adjustment. Figure 2 on the next page looks at 2 indicators of affordability for low-income tenants. This tells the important story that things got much, much worse until the last year for which we have data, which is 2015, when they turned the corner and tenants were doing a little bit better according to these 2 indicators as the economy recovered, as the effect of your low guidelines set in 2014 took effect, but mostly because of incomes. Things got a little bit better, but they are still much worse than they were in 2007 for low-income tenants, and it's not like 2007 was so great. We had a housing crisis in 2007 too. So the message here is that the economy is working. Your low guideline in 2014 is probably contributing to this, although we can't say until we get the better data in 2 years. And yet we still have a long way to go. There's more to be done to get tenants even to where they were in 2007. It's reasonable to expect that incomes have continued to improve for the 2 years since that data, because we do know the unemployment rate on a month-to-month basis, and that has continued to improve. In fact, it's now as good as it was before the crash of the financial markets in 2007, end of 2007. You can see that there. So the message from this rent and income data is the economy is working, your actions are working, but there's more to go. It's not time to stop providing relief to tenants through the setting of rent guidelines. I was also asked to look at the increases that were authorized by guidelines in 2009, 10, and 11, the first 3 years of the Great Recession. And during those 3 years, the price index was way off. In most years, the price index is a pretty good indicator of what actually happens to landlord expenses, but for those 3 years, it was way off. I think the reason is that landlords, cut costs. They didn't buy things they would have bought if there hadn't been a recession going on, and therefore costs were under the projection from the price index. But that's just speculating, but it seems pretty likely given that it happened for 3 years during the Great Recession. So during those 3 years, the board issued guidelines that fit the pattern that existed throughout most of the Bloomberg administration, which was to issue guidelines, that a one-year guideline that was about 60 or 65% of the price index. Since landlords spend 60 or 65% of their income operating the buildings, when you give them an increase that's 60 or 65% of the price index, you're giving them extra income that will equal their extra costs because of price increases. And I infer from the actions of the Bloomberg Era Rent Guidelines Board that they had a policy of doing that. They were holding landlords harmless from the effect of price increases, but stopping there. For those 3 years, 2009, 2010, and 11, they also did that, but they were basing it on a price index that was much higher than the actual increase in costs. So you could say that from the point of view of what appears to be the policy of the Bloomberg Era Rent Board, those increases were excessive. Now, as a tenant advocate, I think that rent increases should be lower than 65% of the price index in years that are bad for tenant incomes, which those years were too. But looking at it from the perspective of what I think the Bloomberg Era Board was trying to do, those increases were still excessive. I tried to calculate how excessive they were, and whether the low guidelines that you have set for the past 3 years have undone that. And the answer is no. Your guidelines have not yet undone that. In fact, this part I have to read because it has a lot of numbers. Over those 3 years, 2009, 10, and 11, the price index increased cumulatively by 14.1%. So if your guidelines had been 65% of that, it would have been 9%. And in fact, the guidelines that were set were 9.3%, so it was pretty close to what I think the policy was. But if the price index had magically been more accurate in predicting what the real costs would turn out to be, and you had known that and acted on that in the same way, the guidelines would have been only 3.3% cumulatively over those 3 years for one-year leases. So 6% less, an error of 6%. And then I also looked at everything that happened from 2012 to 2016 and assumed that I went by the actual costs as measured in the RPIE data for the years where that existed and for the price index in the last year where we don't know it, and compared that to your increases. And in fact, you're still a couple percent over. And in fact, based on this year's price index, a rent freeze this year would almost exactly undo the damage from 2009 through 2011. So if you accept the Bloomberg Era Rent Board's interpretation of what a good rent guideline is, and then you try to correct that back to zero, that is a case for a rent freeze this year. So what should be your policy going forward? It's been tremendously beneficial for tenants that you've set low guidelines for a few years. We've seen that by 2015 that the corner was turned and things were starting to get better for tenants, although we still have a long way to go. That's all good, but nobody thinks that you're going to freeze rents forever. So what is the long-term policy that you should adopt instead of using the one that the Bloomberg Era Rent Board used? And what I would suggest is that in a normal year, you should do what they did and issue guidelines that are around 60 or 65% of the price index. But in years when tenant incomes have suffered, like they did at the beginning of the Great Recession, you should issue guidelines that are lower than that and share the burden between landlords and tenants in that way, and protect tenants from the extreme hardships that result when your income goes up and your income goes down and your rent still goes up. And from time to time, you should do what you did 2 years ago and issue a guideline that is lower than that reason would suggest in order to correct a past error. And I'm saying again, this year, in order to correct a past error, you should issue a guideline that is below what the price index would say, even though unemployment is low too. So there's 3 principles. In a normal year, issue a guideline that reflects landlords' expected cost changes. In a recession year or a year where tenant incomes are hit, adjust downward to the benefit of tenants, and occasionally correct when you can see from evidence that you diverge from the path of those first 2 rules. And on that basis, we believe that you should issue a guideline of no more than 0% for 1-year leases. You could make a case for a rent rollback based on the fact that tenants' incomes were hit back in those earlier years, and you haven't undone that yet. But a freeze would at least be enough to undo the excessive increases due to the 3 years the price index was bad. So that's what we are urging you to do. I hope that made sense.
Thank you. Any questions from members of the board? David?
This is just a clarification about your written comments, and I think possibly your spoken comments as well. At some points, you are using inflation generally, and then in other places you're using the price index. To what extent should inflation generally be relevant to our analysis as opposed to just using the price index that of landlords' costs?
Well, landlords' costs usually rise faster than inflation, and that's why you use a price index instead of just using inflation.
But you do use inflation in some of your remarks, and I was wondering whether we should, why we should be considering...
When you're looking from the tenant's point of view, it makes sense to use inflation, because inflation is supposed to be an estimate of the changes in an urban consumer's costs. So if you're trying to say how much money a tenant has, inflation is the right way to adjust. But if you're trying to make sure that landlords are able to pay their costs, then you need to use the price index, which is a better estimate of changes to landlords' costs.
Thank you.
Any other questions? No further questions. Thank you very much for your testimony.
Thank you.
Yep. I think next is going to be Tim Collins. Welcome.
Thank you, Madam Chair, and thank you again for once again entertaining my comments and thoughts. As many of you know, A number of years ago, I served as counsel and executive director to the board. I also authored the first few editions of the introduction to the board, which kind of gives background on the board's history, its structure, its function, and some key economic indicators of what's happened with the housing stock and the tenant population over the period of rent stabilization. What you have before you, this submission, is really an update, and many of you who've seen my prior submissions will recognize a lot of it covers the same territory, but it's, my basic view of what the role of the board is, and tries to attempt to answer some of the questions and what I think are confusions that arise. One in particular, in hearing the last question that was asked about, what is the role of inflation and how do you consider inflation? There are a couple of aspects to that, and one thing I want to make clear is that although inflation certainly impacts upon tenants, in terms of their purchasing power for other goods and services, my general approach to the issue of tenant welfare and this board's role in considering tenant welfare is sort of twofold. On the one hand, you certainly can consider harsh conditions that are faced by tenants, particularly in a recession, and I think that there's a reason for having a board instead of a formula, and that you can have kind of a bit more of a human response, particularly when conditions are tough. But my general feeling is that the board should consider tenant incomes as a normal market factor, and that is, if you look at what happened during the heart of this recession and the recession of the early 1990s in areas that were unregulated, rents either stabilized, flattened, and in some cases went down. In the rest of the country, rents actually went down. I think it was from 2008 through 2013. Actually, rents dropped a little bit over the full 5-year period. And that's average asking rents. So when incomes go down, purchasing power goes down. Tenants in open markets tend to bargain more vigorously with the owners. Sometimes they'll double up, or they'll create alternatives to just going out and finding a new apartment, perhaps stay with parents longer and that sort of thing. And the consequence is that vacancy rates go up, and rents tend to stabilize or come down as owners want to pay for things. Probably an exception to that, or perhaps I shouldn't say an exception, a total disastrous situation was during the Great Depression, when owners did drop rents, but unemployment was so high and purchasing power was so low that they still couldn't collect the rents that were quite reasonable and quite low under the circumstances. And rent regulation during the Depression didn't make any sense because there was plenty of housing. A lot of people doubled up. The problem with affordability was not being driven by housing scarcity. It was being driven by a collapse of incomes. So there's a kind of a twofold factor to the issue of tenant incomes. And where we see tenant incomes still being relatively low, rent burdens still being relatively high. The last HVS survey put, I think, the average rent stabilized tenants rent to income ratio at nearly 36%, or I think it was actually just a little over 36%. And that hasn't changed much. I mean, I think from the data that you've gotten recently citywide, that may have dropped a little bit, but still in rent stabilized housing, those rent burdens are still pretty high. But I'm not making a pitch based upon a concern for tenant welfare, not asking the board to solve the problem of unaffordability, and I never have. You should just simply recognize it as a normal economic factor as tenants' incomes either flatten or fall. Rents in a normal market would do the same, and I think the board's job is really to try to construct what would otherwise be a normal market in the absence of extreme scarcity. And I've made this pitch before, and it's something that is not really well explored. It's not really well studied. There are some studies out there that indicate that housing policies like zoning and other restrictions on supply are the primary cause of affordability problems where we see them, or high rents where we see them. critical point I'm trying to make here is that you are operating in an abnormal market. That's what the legislation says. And your job is to try to normalize that market. It's very complicated. There are some ways that you can do that, which I'm going to suggest here, but it's important to recognize that, you know, when we're all trained in economics and business and so on, we kind of see things from the perspective of the firm or the corporation, the interest of the business, and you accept the status quo in terms of the regulatory environment as a given. You know, you're not going to go out there and change things. The marketplace is the natural template from which you operate. But your very existence recognizes a legislative commitment to a failed market, or at least one that is that's debilitated, let's say. And so you have to consider other things. So how do you construct normal rents in these circumstances? Well, again, tenant income can be a factor, and I would note that according to I think it's on page 6 of the income and affordability study, wages have actually been flat in the city since 2008. And although employment has gone up a little bit and things are looking a little bit brighter, I think that by and large there hasn't been a real significant change for most of the city's renters. The average incomes are still quite low. I think it was $43,000 is the figure that I saw. But things haven't changed dramatically. If they did, if we did have the booming economy and America was great again, then you could actually factor that in the other direction and raise rents perhaps higher than these other indicators would suggest. Because in a period of affluence, of rising incomes, rents normally go up, other things being equal. And that's fine, but we're not seeing a great deal of affluence or rising incomes. Most of the increase in wealth in the last decade or so has really come at the top. And the wealthiest 1% is now back to pretty much where they were in 2008, but that's not true. A lot of damage was done during the recession, and its effects continue. So how does the board otherwise consider inflation if it's not a tenant, it's not so much an issue of tenant welfare, but what role does inflation have in setting guidelines? And I would suggest that one of the easiest kind of places to hold the tiller through a process of change in a housing market is to keep owners whole. And by that I mean making sure that their increases in operating costs are covered and that their net operating income is protected against the effects of inflation. And as Tom said earlier, inflation has gone up at a far lower pace than operating cost changes. In fact, according to the numbers I looked at, operating cost changes since 1990 have gone up, let me just make sure I get this right. I think it was operating cost changes have gone up 169% since 1990, whereas the local inflation rate, the metropolitan regional inflation rate, has gone up only about 88%. So operating costs have gone up almost twice the rate of the price index. So if you're going to keep owners whole, you compensate them for their increases in operating costs, which is only a fraction of the overall rent roll. So if the O&M to rent ratio is now 58.8%, which was the last solid figure we have based upon the income and expense data for 2015, you would basically make sure that the operating costs or that figure is multiplied times, you use the price index as probably the only, it's the only really current indicator that we have, in order to get an increase to cover actual changes in operating costs. But that does nothing for the net operating income, which would be static if you didn't do something on that end as well. And in order to preserve that, you would multiply it times the net operating income, in this case 41.2%. You would multiply it times the local rate of inflation, and owners theoretically would be kept whole. Of course, there are other factors to consider. Generally speaking, and that operating cost to rent ratio, 58.8%, is really a central figure to focus on. at least in terms of historical trends. And if you look back at where the rent-stabilized stock was, both the pre- and post-47 stock, at the outset of stabilization, the staff had done a study of this a number of years ago, I think it's 20 years ago now, and looked at all of the reports that had come out in that period of time and concluded, based upon the composition of the stock, that the overall operating cost to rent ratio at that time was about 62%. So we're seeing through 2015 an actual increase in the real operating profiles that owners are working with, in terms of now having 41.2% net operating income as opposed to 38% back then. Is that a good thing? Well, it's a good thing for owners, except that the housing stock has aged. The average building in the city, and we don't have precise figures for this, but it's clearly older than they were in the late 1960s. There was a building boom after World War II. From 1947 through the mid-1960s. So there was a lot of new housing in the stock at the time. And in fact, among that housing, the average operating cost to rent ratio was 55%. The older stock was probably around 64, 65%. So you average the two and you get 62. But now, the entire stock is older. And under normal market conditions, that would lead to rising O&M to rent ratios. We should see an O&M to rent ratio perhaps in the 64 to 65% range. But what we see is 58.8%, which means that owners are doing remarkably well. So the other thing to look at is, actual increases in net operating income over time in inflation-adjusted terms. I think that the value of that figure is a bit overstated, though. It's somewhat shocking to people, and I know tenants are going to grab onto this and say, look, owners' incomes have gone up in, again, in inflation-adjusted terms, 57.7% since 1990. That's a pretty healthy increase, and I think, frankly, it's an unwarranted increase. It's excessive. But it reflects a lot of things that are going on in the market, not just what this board does. It reflects new housing. It reflects deregulation, which is a legislative policy not controlled by the board. You have to live with what Albany does, for good or ill, and I wish the board actually played a larger role and had more of a voice in that, because you actually have more information and you probably understand the housing market better than most anybody up in Albany, except for perhaps a small group of people working in maybe the housing and community renewal. But even with that group, I think this staff is, and I often compliment the staff, I think the staff is a solid, objective source of great information about housing, and its reports are used widely by other city agencies and by the state. So you have a lot of information. Again, I wish you had a larger voice. But what Albany does is what Albany does. It may be for political reasons, it may be for sound or unsound reasons, but of course you have to live with that. So the 57.7% reflects in part deregulation policies adopted by the state. It also reflects in part major capital improvements and individual apartment improvements on turnover, vacancy allowances, and some other things that are not controlled by the board. So what is it that this board does? This board adopts the 1- and 2-year guidelines, and at some point in its earlier history it adopted the vacancy allowances as well. And it's developed a fairly robust method for determining how those rents increase, at least identifying how they've increased over the years, and that's in the board's rent index, which shows that rents went up, and Andrew, you could correct me if I'm wrong, I think it was 167%, the rent index, the gross, but there's a little bit of a problem with that because you guys had to pluck out 5.5% in 2004 when you got the total because DHCR didn't have figures for that year. So in order to make an apples-to-apples comparison. Or the finance didn't have figures for those years. Okay, so the real increase in the rent index, based upon what I've calculated, is over time, and I add on projections for 2016 and 17, which are not included in the rent index that's in the I&E report. The total increase is 194% since 1990. Okay, so how does that compare with what owners have needed in order to be kept whole? And in order to construct that figure, I look at the actual income and expense data, and for the last couple of years, I have to do projections based upon the price index, because that's all I have in order to update it. And I also look at the regional CPI, and I take accumulation of that. And if you look at, all of these figures are in this chart at the very back of the submission, and you look at the very bottom and the far right-hand corner, and you see column K at the bottom. For 2017, rents have risen from a base of 100 to 293.73. That's the 194% increase I'm talking about. And in order to keep owners whole, that is to increase the rents to cover operating costs and to protect net operating income from the effects of inflation. I have under column J a projection of what would have been needed, and what would have been needed was 155% increase. So you can see very clearly keeping owners whole would have resulted in far lower guidelines. And again, I have to emphasize this. The column K are not actual rent increases. They actually got bigger rent increases. My differential between the commensurate amount needed to keep them whole and the amounts that this board authorized is only, we're talking about, 40%? It's a lot less than the 57.7% that the staff has identified as the actual increase in net operating income. It's actually a lot less if you think about it in proportional terms.
Excuse me, I'm just having trouble finding the 155 number.
The 155 is at the bottom of column J. You can see it starts at a base of 100 and it goes to 254.63.
I see. All right, thank you.
The increase is 154, to be more precise, 154.63.
Okay, thank
but
you.
I just rounded up to 155. So I actually am saying here that a lot of the increase in profitability that owners have achieved has come outside of what this board does, and I'm not saying that you should somehow punish them or reduce that. It's really not your job to take away their MCIs or to take away their deregulated rents. That's a battle that occurs in Albany or at the DHCR. But if you just look at what you've done, based upon the rent index, which again factors in 1- and 2-year guidelines and would have included vacancy increases, the board, and I say you, certainly prior boards, I think that the board in the last few years has done a pretty sturdy job to try to rein in past excesses. But all told, since 1990, the board has authorized increases that are some 40% higher than would have been necessary to keep owners whole. This is not a plea for considering the welfare of tenants and considering poverty and hardship. I'm not really here to make that plea. I'm here to, and in some ways, although I certainly respect and am concerned about the fact that there are people who are left out by the economy, there are people who suffer poverty through a lot of reasons outside of their control, and that one of the first barriers to living a decent life is to have housing and to have decent housing. But again, I don't think that this board should be focusing on making every apartment affordable. But this board should also not be worried about guaranteeing that every building is profitable and that every owner is doing well. And
Excuse me, I just want to make sure I understand your calculation. Are you saying that your calculation is meant to sort of model a situation where an owner took only the rent guideline increases?
Exactly.
Okay,
Exactly.
thank you.
And if they had only taken the rent guideline increases authorized since 1990, they would have needed 155% to cover everything, to be exactly where they were in 1990. That's where we first get more robust information from the Department of Finance. And in fact, the board authorized 100 and, as I said,
193.
So when you consider this, and when you consider the fact that the stabilized stock is older than it would have been, and you consider the fact that we've gone through a significant recession with stalling incomes. In fact, if the board had authorized the rent increases that ended up coming up a little lower than the 155, that wouldn't be such a bad thing, because it would reflect the age, it would reflect the fact that there are hard times and that, you know, in a normal market, rents would stabilize or dip a little bit. But in fact, the board authorized much more. Now, the vast bulk of those increases really came during the later years. I'll be very blunt about it, the Bloomberg administration. At the time, I was testifying before the board, and I'll also be frank, I felt myself becoming increasingly shrill. I was starting to think, what the hell is going on here? We're in the middle of a recession, rents are flat throughout the country, you know, operating costs are not that hard, owners are bearing none of it. Profitability, and I'll discuss that in a minute, was going up at a time when everybody else was getting, you know, knocked back. Now, let me just say a few things about profitability. When I talk about profitability, I'm really talking about growth in real net operating income. The board doesn't have, probably will never have, and may not be possible to have information about real profitability, because profitability is return on investment. And there's always at least two, and well, not always, but in most cases, there's at least two investors in a building, the owner who puts a certain amount of money down, and the bank who finances. The bank's return is its interest on its loan, and the owner's return is the amount of rent it collects above its expenses. Some owners put very little down on the property. Some owners have inherited their property. They own them outright, and you know, all of the income that comes in is pure gravy at the end of the year. But you can't really understand how profitable these buildings are unless you take a dynamic approach, which also factors in sales prices. And I believe, and I was looking for it this morning because I didn't copy it, if I'm not mistaken, the mortgage survey does have something about increases in sales prices over time. And they've been substantial. And when we looked at sales prices a number of years ago, based upon, I think it was filings with the city clerk's office, it was very clear that sales prices of multifamily buildings in the city have gone up far faster than the rate of inflation and almost anything else. There's been some, you know, slow times, but by and large, if you, and anybody knows just anecdotally, if you know anybody who purchased a co-op or a condo or owned a building 30 or 40 years ago, their return has been phenomenal, including the return of the fellow who's now occupying.
I have a question, just has to do with using 1990 as the starting point for this analysis. So given the turnover in ownership in the housing market, doesn't this end up having go all the way back to 1990 to do this calculation? Doesn't that have a disparate impact on newer owners who are, you know, essentially looking at current cost increases?
Well, yeah, and I'm not sure what the impact is. You know, interest rates are clearly lower now than they were in 1990. So financing costs are far more manageable. In fact, I think interest rates are about as low as they've ever been. And
they're up slightly, actually, but.
Yeah, for this year, yeah. You know, so the financing picture is brighter. I'm not sure that there are more creative ways to purchase buildings, but there's also the process of deregulation, a lot of units coming out of stabilization. So there are a lot of operations that like think of themselves as turnover operations. We're going to push or purchase tenants out of buildings and eventually bring up the rent rolls, and that's something that goes on at a pretty high pace. But I think it's really critical to understand. And it's really an excellent question for, I want to go back, there's a couple other reasons why I think it touches on some important issues. But profitability in rent-stabilized housing is not regulated, period, because nobody holds a gun to somebody's head and says, buy this building. When you look at the income stream of that building, I mean, theoretically, you could talk about somebody who may have owned a building for 75 or 80 years, and they could argue that their income has been affected by the presence of rent regulation. When rent regulation was started in 1968, it started with a rent freeze. Rents were not pushed back. So prospectively, they got fewer rent increases than they would have gotten. But anybody who has purchased, or any building that's been sold since 1970, was sold on a market where owners knew what their income stream was going to be, and they had to hedge their bets against what the regulatory bodies would do with respect to their, return versus what the vagaries of the market would do. And in some cases, it's a combination of the two, again, because of deregulation. But I think the issue about 1990 is important in other respects, and that is, why 1990? It seems an arbitrary line. It's only because that's when we have really good data. We did have the price index of operating costs before that. There were a number of studies done in the late 60s and early 70s about operating cost profiles, and as I mentioned, the upshot of all of that is that roughly owners were realizing about, or expending about 62 cents of each rent dollar collected on operating costs. And again, now we're below that figure despite the aging of the stock and despite the recession. So look, owners have done really well, and tenants have not done so well. Generally, things are looking a little bit better, but rent burdens are still extremely high. Homelessness, I think it's again at a record, was it 59,000 almost. The cost of living in the city, I mean, it's common sense if you go around, the people who are really having a rough time of it are people who are looking for housing or who may have housing but are experiencing large rent increases. And the people who are doing well are the people who own housing. And based upon the numbers that I've given you, although a good chunk of that responsibility is Albany and the process of deregulation that's gone on, another sizable portion of it is what this board's done. And that leads to what do you do with this year's data? Well, my position last year was that rents really should be rolled back because of excessive increases. You do have a significant price index. That's something to consider. It's not something to dismiss out of hand. 6.2% is significant. But when it's weighed against what the board has done historically and the condition that owners are in and the condition that tenants are in just as an economic factor, I think a rent freeze would be perfectly appropriate.
We're hearing from affordable housing providers that, the sort of repeated zeros in terms of increases are having a negative impact on their owners because of the fact that costs have gone up and the pro formas that have been the basis for lending in the affordable housing market have assumed moderate rent guideline increases, and these owners don't have the option of using rent, vacancy bonuses, MCIs, IAIs, et cetera, so that there's a group of, in some cases, relatively new owners out there for whom the guidelines are not meeting costs, and they have no other way of raising rents. What can you say about that?
I think it's a good point, but it goes to an issue that often comes up, which is be careful about allowing the tail to wag the dog, because if you have a generalized increase that is sensitive to new owners or not-for-profits who are in this situation, you may be imposing unwarranted and harsh rent increases on 700,000 or 800,000 other tenants who are not in that situation, giving a continued windfall to owners. There is a hardship mechanism. I think the owners complain about it, perhaps rightly so. I think it should be reformed. I've often suggested that DHCR take a baseline economic profile of what it means to have an economically stable building and just allow owners to, present the information they have as to whether or not they meet that criteria, and then get adjustments very quickly in order to ensure that they have an adequate income. But I think it's an area of reform, just like deregulation, that should take place at the state level. And if you could come up with a figure, like, smaller buildings or something like that, or by location, and allow special adjustments that would help stabilize those buildings, I think that'd be something worth entertaining. But the problem is that it, the size of buildings is, there's small buildings everywhere, and location you can have in any community district of a wide variety of both profitable and difficult buildings. And really what you're talking about is buildings that are pitched and supporting lower income tenants that would have a hard time in any market, even an unregulated market. And maybe they would benefit from stabilization increases, but I think that their arguments need to be pitched to the DHCR or to Albany or perhaps to City Hall, but not here, because I think it would be a grave error to allow that relatively small portion of the market to run the board's decisions.
About your bolded written comments on the first page, which you actually addressed a lot in your oral comments, I have a policy question and an empirical question. The policy question is, what is the policy basis for saying that maintaining the same ratio of operating costs over time should be the primary thing guiding the board in its decision? And then the empirical question is, assuming that we agreed with you about that, how long would it take, how many years of rent freezes would it take to equalize that ratio, given the excessive increases of the tail end of the Bloomberg administration?
Well, look, I don't think there's anything magical or absolute about any of my suggestions. I think, or my focus. I think the operating cost to rent ratio just gives a clear barometer of what happens over time. It's the clearest you have. I mean, there are changes in the stock that may affect that, and other things, but I think that focusing on that kind of tells you what the board has done over time, and what the board has done over time, I think, is excessively reward owners. I think that a very slowly rising O&M to rent ratio, which is somehow reflective of the increased age of the housing stock, and that could be looked at in more detail, wouldn't be a bad thing. In terms of how long it would take you to get there, well, at this point, years. I think that if the board had low or moderate guidelines, we'd be talking 3 or 4 years before you'd be back to a 62 or 64% level. And by the way, I think it's 1988, the O&M to rent ratio was, I think it's about 64. So things have, I'm sorry, did I say 2008? It was, I think, about 64. So
Tim,
owners have done very well.
Just a point of clarification, you're using the audit adjusted when you speak of
Yes,
that.
I am. Yeah, and that's a great point of clarification.
O&M
That's
to
something that,
income ratio.
the owners will raise, well, you have this arbitrary audit and you're just reducing the real world, and, what do we know? There were 50 buildings that were looked at back in the early 90s to determine how much fudging was going on in terms of these I&E statements that were presented to the Department of Finance. And what the Department of Finance found is that there were a lot of capital items that were being stuffed into expense columns, shouldn't have been there, and that there was some outright fraud, and they came up with this factor of, I think it was about 8%, which is this audit adjustment. I think the owners have a point insofar as the Department of Finance should revisit that. 50 buildings some 20 years ago is a long time ago, but we have no evidence that owners are any more careful or any more honest today than they were back then. So to just accept the filings on their face without recognizing that there is some of this kind of fudging and fraud that goes on, I think would be a mistake, and that's why I use that audit. I think it's the more reliable figure. But I certainly would encourage the board to reach out to finance and say, it's time to look at this again and update things and, add some more buildings.
Well, just a point of clarification, we did do that. You can see the testimony online.
I'm sorry?
We did do that.
And?
Finance came in. I mean, there's like almost 98% of owners participate, so they feel like the outliers, the 8% is not relevant at this point.
When did finance come in?
What meeting did they come?
First meeting this year.
First meeting this year.
They came in this year, and they
Yes.
said they did not need to audit them anymore, that they were now reliable, whereas they weren't 20 years ago?
basically what they said is that they have 98% compliance, and that just statistically speaking, and by looking at the patterns, they feel that they are reliable.
I don't think they said it was reliable. They said there's a median where they'll give people acceptance of costs, and anything above that, they discount those additional costs. They didn't say the data was reliable in and of itself. They're just saying we're benefiting up to a certain point for all owners.
They make an adjustment in the way they actually then do the assessment, as I understand it.
Is that something that's happened over time? They've improved the figures?
Yeah, well, there's a couple things on that. They have a much higher reporting rate, so when they use those figures in their assessment, they're more confident of what they're doing with their assessments. They do make some adjustments if they find buildings that are outside a group of, that should be operating at, a certain ratio. They'll make some adjustment and assessed on that amount, not what necessarily the owner is reporting. But that happens both ways, those that are below what the ratio is and above the ratio. And they've also taken the form over the last 4 or 5 years and made it clear what can and cannot. It's much more clear what you can and cannot include in the RPI forms. So we're trying to get more data, but, whether that audited adjusted number from back then, it's a different world now, so we're trying to sort all that out. So we've also included, it's 64% is the O&M ratio without any audit to it. So to say that it's there or it's not, maybe it's somewhere in between, maybe it's the, but we're going to try to explore that going forward.
Listen, I think that that's certainly worthy of consideration, and it may well be higher. But I will say this, the adjustment that was made a number of years ago was not based upon the compliance levels in terms of the percentage of people who actually filed. It was a randomly selected 50 buildings of those who did file, and it was found at that time that some owners were stuffing capital items in the expense columns, and that there was some outright fraud going on. And based upon what you've told me, I don't think that in the absence of a comparable kind of audit, that any conclusion should be drawn that, these numbers are more reliable. Again, it was a sample that was taken. It wasn't based upon the total numbers. And there's another really important thing here, and that the owners have challenged the use of the income and expense data because of the absence of the smaller buildings. So there was 6 to 10 unit buildings are out. And that is a valid point when it comes to looking at the, a static 1-year shot of what's going on out there, because you are missing some of those small buildings which may have different operating cost profiles. But it doesn't make it, or it would be very unusual that would make a significant difference in year-to-year longitudinal comparisons. Because there's no evidence that there are changes in small buildings that are radically different from changes in large buildings. So if you're looking point to point to point, and you're looking at trends, which the staff has done, those are pretty robust comparisons. And so the conclusion that net operating incomes have gone up, 57.7% since 1990 in inflation-adjusted terms, I think is a very robust figure. Whether or not the I&E ratio, the 58.8%, the operating cost to rent ratio is 58.8% or 59 or 60 or 62 is something worth exploring. But I would not accept the Department of Finance's statement on their face. And I would note that this board has legal power to call upon city and state agencies to provide information that it requests. It's in the law. It's rarely exercised. But I think, a good discussion about, we need to double check this to give confidence to both tenants and owners that we're using reliable data. We would like you to pick a random sampling of buildings and look at them more closely, scrutinize them. It's certainly warranted after this many years, and given the importance and the critical nature of that data in the process.
And Tim, I think you keep saying cost to rent ratio. It's the cost to income ratio.
Cost to income ratio, I meant. Yeah, absolutely. Yeah, generally referred to, but it's total building income, yes.
So-
And the reason, by the way, why I use the total building income is because the baseline figure that, as I understood it from back in 1970, and you'd have to look at the old Table 14 report, used total building income.
So if we were reset at this point, if we believe for whatever reason that the last 3 years have corrected the excesses of the Bloomberg administration, RGB, then in terms of looking forward, do I understand correctly then that you're advocating essentially the commensurate that we use for CPI-adjusted NOI?
No, I am advocating the use of the commensurate, including the vacancy factor, under normal circumstances. But what I presented to you here is is a calculation, again, of what owners would have needed in order to be kept whole since 1990, and I have 155%. The board authorized 194%. To bring that number closer, I think that the board should lean, and quite heavily, against, short-term jumps. And again, by the way, there's nothing unusual about this. I think I testified, it was a couple of years ago when the price index was around a tenth of a percent, or it might have even been negative, I don't recall exactly, and I basically said, that's not the critical factor. Don't pay attention to it that much. What you should be looking at is the long-term trend, and the long-term trend is still one of, I think, very substantial overcompensation of owners based upon what the board has done. I think the board can put on the brakes. It doesn't need to, be myopic and focus just on the commensurate rent adjustment.
But that's because you're saying the commensurate rent adjustment doesn't take into account the historical trend.
That's exactly right.
Okay,
Yep.
so if we disagreed with you for whatever reason about where we are in terms of the historical trend, just methodologically, what you are suggesting is a CPI-adjusted NOI with the vacancy increase.
I would suggest that as a starting point. I would suggest that as a starting point to determine, okay, in answering the question, how do we keep owners whole? And again, I would include the vacancy adjustment in there. Again, there are these other factors, the aging of the housing stock and the relative stalling of income growth. That spills over into homelessness. It affects rent burdens. And again, these are economic indicators, not just humanitarian indicators. And so I would certainly lean against this year's commensurate. And the other thing is my sense is that, and I'm not sure, I think the projection from the staff, as I recall last year, they were suggesting a 5.9%. 5.5, and it came out at 6.2. So I think it's a pretty darn good job. And this year they're suggesting 4.4. I know the oil markets are pretty volatile. I don't know, they may well go down. So I'm not sure if you remember, your guidelines go into effect starting in October, and they affect a third of the leases for a full 2-year period. People who
Well, the commensurate doesn't use the PIOC, though.
I'm sorry?
The commensurate doesn't use the PIOC
Projection.
Yeah,
projection.
yeah,
Does not.
yeah, that's right. Yeah, it's just because you're looking forward, because the PIOC ends in March, pretty much.
Yeah, the commensurate's designed to compensate owners for the expenses they incurred over the past 12 months, not going forward, except for the traditional commensurate they use as project.
Right.
I'm not sure if I understand your focus on the aging of the housing stock for a couple of reasons. I'm just not sure what your argument is based on the aging of the housing stock, and I'm also just not sure, intuitively, I'm not sure if I agree with your assessment of the housing stock. So the housing stock, leading up to 1990 was in terrible shape. We had this massive increase in abandoned buildings and buildings going to in-rem, taken over by the city. And there's probably been an immense capital investment in the housing stock since the early 1990s, I would guess. So could you just play out for me what you believe the state of the housing stock is? What is the relationship of capital investment in the housing stock, and exactly why we should care about the age of the housing stock?
Well, from all of the studies that I've looked at, older housing has higher cost to rent ratios. And if you look at the RAND studies in the 1960s and so on, some of these older buildings had operating cost to rent ratios up in the high 70s and even the 80s. It wasn't a great time, so I wouldn't use that as a great indicator of what a healthy relationship between operating costs and rents are. But nonetheless, there was a direct correlation between the age of the buildings and the level of net operating income, the inverse part of the O&M to rent ratio. Let's see, so when we have precise numbers on the medium age, we don't have precise numbers on the medium age. The HVS data shows, we know that in 1981, 80.3% of the rent-stabilized stock was over 20 years old. In 2014, 92% of the stabilized stock was over 40 years old, according to my review, and there's a reference to the tables here. So the stock has aged, and there may well be, new investment and capital improvements and so on. But as a general matter, as the stock ages, the return will decline. Doesn't necessarily go to zero, and of course, if there is a substantial rehab, a full gut rehab with all new systems, you basically got a new building. But by and large, in a rough and ready way, as it ages, those ratios should go up, the cost ratios, and they haven't, they've gone down. So I think all other things being equal, which is a phrase I hate to use because all other things are never equal, but if they were, those O&M to rent ratios would slowly creep up over time.
So why do we care about the age of the housing stock? I mean, why don't we just look at the ratio itself?
Because if the ratio appears to be declining, which it does, I mean, it was what, even putting aside audit versus non-audit, if you look at the trend, 64% O&M to rent ratio in 2008 down to 58.8% in 2015, there's clearly a greater level of net operating income. And that's at a time, again, while the stock is older than it was back in 1970 when it had a higher O&M to rent ratios.
But you can come to the same result that you did, ignoring the age of the housing stock, just by looking at the O&M ratio.
Well, no, what I'm saying is that it's not troubling or surprising if the stock is aging and the operating cost to rent ratio is climbing a little bit. So I'm saying holding on to a stable, unchanging O&M to rent ratio is myopic. You've got to consider these other factors, including aging, which is a kind of it's a little fuzzy. It's not clear, it's not precise. And the other thing, of course, is tenant incomes in a recession. Like I said, in a normal market, net operating incomes would decline a little bit because the number of dollars chasing rental housing is going to decline. But that doesn't happen in a rent-regulated environment where you already have severe scarcity and rents, or at least the increases, are capped.
Okay. One last question, and then we have to move on. We have other speakers.
Yeah. Just on the net operating income, so we've seen a decline in net operating income over the last 11 years. So what do you think then a healthy level of net operating income is if we're trying to, in some ways, correct the market?
Look, it's a judgment call. I think that if net operating income was around 35%, if the O&M to rent ratio was around 64 or 65%, given what we know, and it'd be nice if we had more information, certainly be nice if we had new audits. It'd be nice if we had precise information on the changing age of the housing stock, coupled perhaps with the amount of rehabs going on. But I think that if the O&M to rent ratio had risen from 62 in 1970 to 65 in 2017, that would not be something that really troubles me. Now, let me just finish. Again, it's really important. The marketplace is not a neutral template here. The New York City housing market is massively distorted by zoning, by strict building codes, by landmarks and so on, by a commitment to, public lands and spaces, and the consequence of that is to dramatically raise the value and the desirability of existing structures. That's what drives rents. That's scarcity. And it's largely a product of what the government does. And the ultimate burden of those choices, which are aimed at preserving quality of life and making this a great city to live in, is to really crush lower-income people and working-class people in a way that substantially privileges owners. And although, again, if you were operating from a firm or a corporation, you look at the marketplace as a neutral template that you're operating in, your very existence is, is because that marketplace is not neutral, because the state legislature has said we need something in between what would otherwise be a rogue market and tenants who need housing. And that's what your job is. So you should be very comfortable in trying to steer a middle course, balancing out all of these considerations, not as a matter of welfare, but as a matter of sound economic policy and economic fairness. Thank you.
Thank you, Mr. Collins.